All right, a lot to unpack on this week's monthly mortgage rate update. Want to take a look at what's happening with interest rates, have a conversation around where we think fixed rate mortgages could be headed as we look at what's happening in the bond market. Talk a little bit about OSFI, some of these changes that are coming down the pipeline. Really high level, but we'll get right into some of these products and rates. Once again, welcome back to the channel. It's Friday, Finance Fridays, and I'm your host, Anthony, with In Touch Mortgage Solutions. And if you're new to the channel or returning and you haven't subscribed, we invite you to do so. And don't forget to hit that notification bell so you're notified every time we post a new video. And don't forget to share your comments in the comment section below. Let us know what you're thinking is happening right now. It's very important that we can share this information with as many Canadians as possible. So, in this week's episode, obviously talking about this week, the Office of the Superintendent of Financial Institutions left the mortgage qualifying rate, the MQR, the stress test, unchanged at basically the contract rate, the rate that you get, plus 2%, or 5.25% plus the 2% mark. And we'll quickly see with some of these rates that are happening right now, if it's going to sort of benefit or help Canadians as we approach this mortgage renewal cliff that is headed our way, and if interest rates obviously don't come down, what it could mean for Canadians. So obviously even OSFI is pointing to some additional concerns or stresses with some of these combined loan plans, these readvanceable mortgages. That's a mortgage that you would have got with a line of credit component attached, very simply put. And as you pay down your mortgage, this credit facility or a line of credit or HELOC, home equity line of credit, would open up. And obviously there are a lot of concerns on how Canadians are using these particular instruments, financial instruments, to either, maybe make their mortgage payments or continue to leverage on these particular accounts as interest rates have gone up. We've definitely seen what's happened with the Bank of Canada, which has increased its policy rate, which impacts obviously lines of credits. And a lot of banks like Scotia have already adapted new policies to sort of pull back on these lines of credits. So they want them basically at 65% loan to value. OSFI is pointing to potential risks that, this could be keeping home prices, pretty static, pretty consistent, because of the fact that we're not seeing defaults, right? Many Canadians could be leveraging on these lines of credits to make their mortgage payments and not being forced to sell. And obviously the amount of debt that is being accumulated in these particular lines of credits, we have definitely seen consumer debt levels hit very high levels. And this is a major question. Obviously as we talk about these things, we get these data points. It's important if you have one of these combined loan plans or these home equity lines of credits with your mortgage, pay attention to your mail. Especially if you're leveraged on those lines of credits, what does it mean for you? Each bank is different in the way that they may tackle these scenarios. I know Scotiabank, as I said, has done some particular measures to address it, but it is important that you read your mail, check with your mortgage professional, or reach out to your lender if you have questions about this particular product, as it is very important for Canadians, especially if you're leaning on these lines of credits to make those mortgage payments. And if they start reducing that capacity, will that force maybe some Canadians into a position where they need to sell? So have a conversation with a mortgage professional. It may help you stay in your home or keep thousands of dollars in your pocket. And in addition to that, obviously we've seen the bond market retreat from its highs that we saw back in October, November, where things were sitting around 4.4 and higher at some particular points. And now we're seeing those bond yields drop, especially for the 5-year Bank of Canada bond, which is obviously the barometer for most 5-year fixed rate mortgages and other instruments. And obviously as these rates continue, these yields continue to drop, while we're seeing a lot of the banks drop their rates just in time, obviously, to end off the year and ahead of the new year, where millions of mortgages are going to come up for renewal. Now, although the rates have come down significantly, is it going to be enough to avoid a lot of situations for Canadian households that are finding it difficult? And this is the million-dollar question. We're going to keep an eye on those rates. And obviously, things are moving at a rapid pace right now. A lot of fear in the economy right now about a recession, whether you're in one or we're getting there. Obviously, a comparison to the US, whatever happens there. A lot of the bond market is reacting to these particular nuances as they maybe sense that the economy is going into recession, especially here in Canada. They're going to note that the Bank of Canada may have to cut rates. And as a reaction to this, talk, this overarching looking at what's happening right now in the market, the bond market reacts to these things, right? Maybe they're overreacting, maybe they're underreacting, right? They tend to maybe overreact in some regards, but if they sense that, the Bank of Canada is going to have to cut, well, we're going to see some easing in these potential yields as the fears of recession, the economic data, unemployment become more prevalent, and then obviously what's happening with unemployment, right? So all these things play into what's happening in the bond market. Is it one particular thing? No, it's generally multiple things that are sort of indicating what's happening there. So I mean, with all that being said, we know that the Bank of Canada hit pause earlier this month, and the next meeting is going to be in January. So we'll have to look at how all these things play out. And obviously, I think come the new year, come the spring market, whatever happens with the real estate market, talked about this, even if interest rates drop, it doesn't necessarily mean that we're going to see a huge run up in people running back to the market, especially if we have recessionary fears with job losses and economic uncertainty. Only time will tell. I want to hear from you, our viewers, what you think is going to happen come the spring market. Will we even have a spring real estate market, even if interest rates drop? And if interest rates drop further, well, what will happen then? But let's take a look at what's happening right now with these rates. And as we get into them, it's very important to understand a few different things. Obviously, what an insured mortgage is, what an insurable mortgage is, and what a conventional mortgage is. We've talked about these particular things, but just as a quick recap, an insured mortgage, less than 20% down, you have to have a purchase price that is sub 1 million, and you have to take on a 25-year mortgage with mortgage default insurance, as opposed to an insurable mortgage, which is you're putting down 20%. You're not paying the insurance premium. The lender generally insures it, but you have to have a 25-year amortization. Once again, the purchase price, or if you're switching or transferring, this is another nuance within the insurable product, that valuation has to generally be below $1 million. You have to be 25 years or less. And obviously, as I mentioned, you do not have to pay the insurance premiums for the mortgage default protection, whether it be CMHC, Canada Guarantee, or Sagan. These are covered by the lender. And this is where a lot of clients right now are seeing some favorable turnarounds, where their banks are not offering them such an aggressive rate, and they're able to find rates with these particular products. But it's very important to understand there's a lot of fluff out there, and there's a lot of stuff that is not going to be as advantageous, especially for individuals that are looking to renew or basically move their mortgage from one lender to the other. Because of the fact that if they're taking on a longer term and rates drop, are you tied to that mortgage? Are you able to basically, move yourself out if interest rates drop? Can you even pay the penalty, and what that penalty will be? Obviously, this is a conversation that you should be having with a mortgage professional. Make sure that you're getting the right product. Now, the other important thing is we talk about variable rates in these particular rates as we go through them. A lot of conversation, clients are starting to come back or warm up to variable rate mortgages. And obviously we're presenting them with the data saying, hey, you have to be very cautious. It can go either way. We saw what happened over the last little while. So, many Canadians are starting to see this at the top of the Bank of Canada spectrum of rates, and now they can potentially be cutting. So a lot of them might be chasing that variable rate as things start to maybe come back down. Whether they're right or wrong on their predictions, obviously the client chooses what they want. And if they believe that that is going to happen, it's important to select the right product, because not all variables are the same, right? We've seen this over the last little while with these extended amortizations on the static trigger rate mortgages. If you have a lender that has the trigger rate or does not allow that payment to change with the Bank of Canada policy rate or the prime lending rate, even if interest rates drop, all that means is more money is going towards principal than towards interest, but your payment remains the same, as opposed to a true adjustable mortgage that the payment will obviously fluctuate up or down. And making sure that you're selecting that right product, if that's what you're chasing, then you need to make sure that you're choosing the right variable if that's what you want to do. So let's get into some of these rates right now and see exactly where they were. As we sort of go through our rate review for December, the 5-year insured mortgages back in August were sitting at around 5.39%. Now we're at 5.14% as of December 14th, I'm filming this video. And obviously 5-year insured variable rate mortgages are basically still in around the prime minus 1% mark. We've seen a little bit of a deviation in these rates, maybe prime minus 105, maybe minus 110. So 6.1 to 6.2 right now. Most banks are around the 6.15 to 6.2 on the variable for a full frills product, the one that you would want to have, that's going to give you no bona fide sales clause and no other strings attached with full prepayment privileges. And then you have your 5-year conventional mortgage sitting at around 5.84 back in August. We've seen that sort of creep back up, and now we're situated around 5.54 Obviously, some major moves between August and now, over a full percent. And obviously, almost a full percent from just last month, right? So a lot of these particular products are coming down just in time for this mortgage renewal cliff. And then you have your 5-year conventional variable rate mortgage. And those we've seen a little bit more discounts. Some of the banks are coming back to the table with a little bit more aggressive discounts. Nowhere close to the insured mortgages, right? Those insured or insurable products. But they're starting to get there, and we're seeing around 6.8, 6.7 to 6.8, 6.9 in that variable rate product, depending on the lender and the options that you want. And then there's your 3-year insured mortgage, anywhere from 5.84 all the way down to 5.49. That's really good for some clients that are looking at that, shorter term financing product. Obviously, there's the 1 and 2 years. Those are still, in and around the 7% mark, just under. A lot of clients, these are some of the most popular products right now, but obviously, having a conversation with your mortgage professional, if any of these products don't meet your needs, you want maybe an open product, or you need an equity lender, or you're looking for a line of credit. There's obviously so many different products. And then moving to your 3-year conventional, we're at about 5.69%, and huge move from just the previous month, where we saw things at 6.74. So you can see things are moving in the right direction for many Canadians who are either looking to get out there and purchase a home, or restructure potentially their existing home, or they're looking, at their mortgage renewals that are coming up and saying, okay, we were planning for higher rates. Things are starting to come back down. And then, that brings us into the conversation around the 6-month insured product. Some clients that are approaching renewal, they think, hey, I got to renew maybe in the new year. But I think interest rates are going to drop by the summer. They may opt for a switch or transfer or purchase into a lower rate insured product, obviously meeting those guidelines. And that's around 4.69% for 6 months. And then obviously having that conversation of what happens next, right? As this product will renew much more quickly. And looking at all these things in combination, we definitely see the bond prices pulling back. We see some things headed in the right direction, as we've mentioned. But we don't necessarily know if this is going to hold for a longer time. As I said, there could be some catalyst, some event that comes along. Maybe the CPI numbers that are coming out next week on the 19th. Obviously, that could change or sway the Bank of Canada's decision. Although, you have reps like Stephen Pulez, the former Bank of Canada, governor of the Bank of Canada, Stephen Pulez, he came out and said, I think the Bank of Canada is done. But obviously, they're not going to say that, right? They're not going to come and say, hey, we're cutting rates, planning on it. We're basically our backs up against the wall. Obviously, that is a conversation that's happening in the markets right now. But remember, it's important to understand that what happens with the Bank of Canada, the central banks, and what happens with recessions, all these data points, growth, GDP, can influence the bond market if things go the other way. Obviously, that could determine that bond yields could go back up. So if you're approaching mortgage renewal, or you're looking to get out into the market and purchase a home, the best bet is obviously hedge your bet. Get a pre-approval, lock in your renewal, lock in your refinance, talk to a mortgage professional, help keep thousands of dollars in your pocket in the event that rates end up going up. And obviously you can play around with some of those options and solutions. If you're looking to buy, what refinancing looks like for you. If you download our app in the description box below, it's free. And obviously you can play around with those numbers on your own free time, and see exactly what you can anticipate moving forward. And we want to just find out from our viewers, what do you think is going to happen with these fixed rate mortgages? We're going to see them come off a little bit just in time for all these millions of dollars of mortgages that hit renewal. Obviously with an election coming up down the pipeline, what do you think is going to happen with these fixed rate mortgages? And do you think the Bank of Canada is going to have to cut rates? Obviously, big question. And we want to hear from your viewers. Let us know. Did we get it right? Did we get it wrong? Obviously, we're going through this journey together, and no one knows what's going to happen next. Obviously, maybe the next few months, we know we have a good idea, but obviously outside of that spectrum, of that scope, very difficult to guess what's going to happen with fixed rates or variable rate mortgages. We want to hear from you. So we'll leave the video here, wishing everyone a wonderful Friday and even better weekend ahead. Thanks again for clicking. Thanks for watching. We'll see you next week.